Good afternoon, everybody. Want to welcome you to today's presentation of our Retirement Income Strategies webinar. This is a joint presentation from Libro Credit Union and our partners at Aviso Wealth. These webinars that we've been presenting over the past several months we've covered a variety of topics. For those of you who have not attended these webinars previously, they are all available on our website, on our events page. There's a number of different presentations, everything there from first-time homebuyer seminars to budget building to family farm succession to fraud and scam prevention and other great topics. So if there is anything that catches your interest either today or you want to go back and review some of our previous webinars, those are available. I apologize, I'm still not seeing the slides here, so I'm not sure what our audience is seeing, but on behalf of our colleagues at Libro Credit Union, I certainly want to proud to present today's webinar. We are trying to raise the standard of both financial resilience and financial understanding of our owners and potential owners in Southwestern Ontario. My name is Paul McQueen. I'm the VP of Wealth at Libro Credit Union. I don't really like the title very much. I'd actually prefer it to be something along the lines of VP Financial Planning and Investor Behavior, because I think that better reflects the work that our coaches do with our owners each and every day. Today's topic on retirement income. I always am reminded about a story when I was a relatively new advisor, so we're going back a number of years now, that I had some clients that by any reasonable definition were frankly wealthy. Long-term money concerns were likely not going to be an issue of theirs. They had obviously done a lot of great work throughout their lives, building wealth, generating wealth, saving, deferring today for retirement comfort tomorrow. Unfortunately, the husband in this partnership ended up in hospital. He was fine longer term, but he ended up in the hospital. And I got a call from his wife who had asked me whether or not she could afford to pay for the TV in his hotel room. And at first, what seemed like kind of a sort of nonsensical request, because of course you can afford to pay for the TV, was eye-opening for me, because it provided some context for that transition, that work that we do as planners and advisors, coaches, that work we do as individual investors to build up our savings over time. It can be difficult to switch that mindset from savings to spending. So certainly be pleased to be joined by Doug from Aviso Wealth today. I apologize, I'm just trying to do a quick fix here on my screen. Doug Carroll is the tax and estate specialist for Aviso Wealth. That's the wealth management partner to credit unions across Canada, including Libro. Those of you who may have a mutual fund account with us through Credential Asset Management or an investment account with one of our Credential Securities reps, this is all part of our Aviso Wealth partnership. Doug previously ran an estate planning law practice and was an advanced case consultant with a life insurer and a mutual fund provider. Doug holds a business degree and a Master of Law specializing in tax and is qualified as a certified financial planner professional and a trust and estate practitioner. He's been doing this for over 25 years now, supporting our financial advisors from written articles to individual case consultations and, of course, webcasts as we are doing today. I'm going to turn it over to Doug now and hope that his screen sharing process is working a little smoother than ours. Doug.
Okay, I'm putting up my screen there, and you let me know, Paul, if you see my screen. I think maybe you see me right now.
I've got your screen too, Doug. I think yours is working properly. Thank you.
And my PowerPoint's up there too. Okay, good. So I'm going to continue on then, and I just want to underline what you just brought up there about this transition that people go from saving towards retirement, which is a common topic that obviously in the financial service industry is about counseling people, assisting people, coaching people to save in an adequate way to take care of themselves into the future. But then when you get out to that point where you're using that money, where you're spending that money, it has been for quite a long time almost an assumption that, hey, everybody knows how to spend money. Why do people have to be coached at that point in their lives? But it is important that you understand not only how you accumulate money, but how you then decumulate, and that's the word that we're using here, retirement decumulation, or how you spend that money and draw down off of that wealth. But beyond the money up and the money extraction, what happens with your life in your retirement years? So that's what we're going
Doug,
to get into
I'm sorry.
here.
I'm just going to jump in for 1 second because I messed up with the original part of the presentation. Something I wanted to share with our audience. Doug is certainly going to present today, and we're open to taking questions from our audience. Up on your screen, on your individual screens at home, because we can't see you or hear you, there is the opportunity to ask questions in the Q&A feature. So please use that chat feature to put your questions in. I'll interrupt Doug a little more appropriately down the road with some questions for him. We do ask, though, if you have questions of a very, very personal nature, we may defer those to one of our coaches here at Libro, and we'll certainly do our best to answer those questions or any other general questions in a appropriately as we can. So apologies for interrupting, Doug. I thought I should put that in there before you got rolling, and we'll pause for some questions throughout the presentation.
Yeah, no problem. And yeah, that's the whole idea here, that we don't want to too artificially close everybody down from asking the question. So if there's something that comes up that really hits on the point that I've got on right now, then go ahead and hold me up, Paul. You're the boss. So the topic, as I'm going through it here, these are the 10 topics that I'm going to bring up. There's 10 slides. There might be one extra one here somewhere, but anyhow, this is it, of the number of slide changes that you're going to see here. And a fair bit of this is just laying the groundwork conceptually of how you live your life in retirement. So feeding into that thought process of how you intend to spend your time, and then how you are spending your time, and the impact that has on your spending or your spendability of the money that you have. So I'll get into a few things that are not deep psychology, but touching on things that are about the psychology and the activity of being in our retirement, and the connection back to the money, the numbers here that we have. So this is not a deep arithmetic type of presentation. Much of it is about conceptually what you're doing, and the starting for that is to look at the question that you have in your retirement of what is the main question that people tend to have going into retirement. And usually it is the, when can I retire? And quite often it is that, well, age 65 is retirement age. Historically, that has been when a lot of public pensions have started in full, have been available to people. And so a lot of people look at that and say, well, if that's when I can retire, then that's when I will, or I should retire. But really, there's a lot more to it than just what age you're going to be at. It's going to be as important, or actually more important, in my opinion, that you have accumulated enough that will take care of you through your life expectancy, that you have the money that will be available so you can live the life that you want. And then you look beyond just that when question, and you get into all the other questions that surround it. And the reason why I have this elephant here is because this is the old fable from the Indian subcontinent about the blind men, and they're touching on this thing, trying to figure out what it is, and each of them is touching on a different part, whether it's the trunk or the side or the tail, and each of them says what they think it is, whether it's a snake if it's the trunk, and if it's the tail it's the rope. But really, it's not any one of these things, it's all of these things at the same time. And so that's why these questions are all about all the different aspects of your time that you're in retirement, not just the when, but what do you have that's going to take care of you? Who are you going to spend your time with? That's going to be obviously yourself and your spouse, your significant other, whoever that might be, if you have one. But beyond that, extended family, and then what's going to happen with your estate, if that's part of your conscious planning, to make sure that you have something to provide for others beyond yourself when you're no longer around. where you're going to spend the time during your retirement, not only where you're going to spend it geographically, but the immediate surroundings, how you're going to spend your time, the condominium or the house or the entire spread across the ranch, whatever it might be. The way that you're going to spend your time is about the where. And then why is that question that you ask of yourself, like, what's my purpose? And certainly as you get into your retirement years, what does tend to happen to people is that their purpose has long been defined by what it is that they do. Either that it is work outside the home, where their particular profession or expertise is what has defined them, intentionally or not, or taking care of the home, that the definition is those people who I'm taking care of is who I am. But now that I'm not taking care of those people, now that I'm not working in that place doing those activities, who am I now? And that can certainly have an effect on the decisions you make about the things that you do in your retirement. And the last thing here then, in terms of the questions, is how it is then you take care of yourself money-wise, how you decumulate the money that you have accumulated over the course of your accumulating working years. So as I said, I'm going to get into some of the numbers here. So I'm going to lay out the different types of sources of money that are available to people in their retirement years. And I'm going to pull it together and give you, again, a little bit more of a conceptual view of how you draw off of those things. So the first one that I'll start with, I made mention of it earlier, is public pensions. And the two public pensions that we have, the two main programs that we have, are the Canada Pension Plan and Old Age Security. We also have, connected to the Old Age Security, the Guaranteed Income Supplement, which is to alleviate poverty. And it is for people who are at low income, whether that is the couple being at low income, or it's that one of the couple is at low income, perhaps later on after the first has died. And that part of things, the Guaranteed Income Supplement, I'm going to leave alone. I'm going to talk mainly about the CPP and the OAS. And again, the GIS, the Guaranteed Income Supplement, is actually a component of the Old Age Security. So the Canada Pension Plan is a program that's available through the government, where if you have worked during your working years from 18 up until 65, or actually you can actually extend that out to age 70, that you can make contributions into the CPP if you're continuing to work at those years between 65 and 70, but commonly between 18 and 65. If you have been working, then you are required and you are allowed, I actually think it's a positive thing having the CPP, you are making contributions into the Canada Pension Plan, which are premiums that you are paying that buy you a later retirement income. There are also other components to the Canada Pension Plan, like the disability pension, and there is also an amount available for children if you are a person who becomes disabled or you die as a CPP contributor. So there are a variety of other things that attach to it. But the retirement pension is the core part of what the CPP does. So the Canada Pension Plan, at its maximum, if you have contributed the maximum credit amount over the course of the years during your working time between 18 and 65, and there are some years that can be taken out of that because it is expected that you will be doing some kind of education and training and being out of the workforce sometimes because you might have a disability of a short-term nature. But generally, if you're fully employed during that time between 18 and 65, then the maximum pension you would get at the age of 65 is $15,043. So I'll just call that 15,000 right now in 2022. And that amount indexes from year to year. You can take that pension earlier or you can delay it later. If you take it earlier, then for every year prior to age 65, you can take it as early as age 60. Every month prior to age 65, you get a 0.6% reduction of the amount that you get under the CPP. And if you delay from age 65 out to age 70, you get a premium for every month that you delay of 0.7%. So you can see the range here that you could get starting the pension at age 60, you could get about $9,600. Again, that's the maximum you'd be entitled to. Or if you delay all the way out to age 70, it'd be $21,000. These are all current dollars, 2022 dollars. And again, these figures index over the course of time. Now, the old age security is a little different. The old age security is not dependent on your working time. Old age security is based on your residency in Canada. And then once you hit the age of 65, if you have been a resident of Canada for at least 40 years after the age of 18, then you will get the full old age security amount, which currently stands at about $7,700. If you have been a resident of Canada for more than 10 years, but less than 40, then you'll get a proportional amount of this full figure. And like the CPP, if you delay in starting the old age security from age 65, you can get a premium on that for every month. You get a 0.6% premium. So if you waited all the way to age 70, you get $10,000. And I'm going to talk directly about this notion of, should you take it on the date, the quote normal retirement date, or might you decide that you delay in some way? I'll talk about that a little bit further on. But there gives you our two main programs, CPP and OAS. So with that, I want to talk about this marshmallow concept, and I expect that most of you will have heard about this idea. There's a fellow by the name of Walter Mischel. He was the lead professor back in 1970 who started in these studies, where what they did was they had a couple of marshmallows. They did different things. It just became known as the marshmallow test, but there were all sorts of different things they did it with, treats that they would offer to children. They would be children ranging from about age 3 to 6 in the earliest versions of these trials, where they would say to the children, here is one marshmallow or one candy or whatever it might be. I'll just call it the marshmallow test, because that's what it's known as. And I'm going to leave the room now as your friend. They don't say, hi, I'm a researcher, but I'm going to leave the room now. And if I come back and that marshmallow is still sitting there, then I'll give you a second one. And the test was to see just how much the children could manage themselves to control their self-control, their craving for this thing. And it was the observations that the researchers were doing about what the children did and how they managed things. So that's what it was originally, and there was all sorts of different variations. Now, Mischel, just a few years ago, he actually died about 3 years ago now, but back in 2014, he did a follow-up book on this. And his follow-up book talked about the earliest studies, and then it had all sorts of other things that they had learned over the years and decades since. And one of the main things that they learned, and this is the quote that I've got here, I'm just going to read it off directly. The most important thing we learned is that self-control and the ability to regulate one's own emotions involves a set of skills that can be taught and learned. They're acquirable. Nothing is predetermined. So what happened with those original studies is they followed up and they looked at some of those children decades later and how they had done in life, whether they had become large managers or entrepreneurs, or if they had challenges later on in life. And they actually found that their self-control that was exhibited in their very young years was reflected statistically across the whole group, was reflected in their ability to manage later on in life. And where this comes back to with the old age security and the Canada Pension Plan is that people tend to be inclined to say, hey, I qualified for it, I want it, because if I die tomorrow, I won't get anything, or I'll get nominal amount of it, so I'm going to get it now. If you look at the statistics of being somebody who is 60 or 65, apart from you having a particular health condition, then statistically, you will live out to a longer age and be better off, most people will be, for delaying taking both the CPP and the OAS to a later year and likely to that age 70. And I'm not going to say that that applies in every circumstance. There are going to be other factors that will contribute into that, like where your wealth is otherwise, other places where it might be, the nature of the relationship that you have and the two people who are involved. But delaying that off, couching your thought process in terms of I am going to delay as my default rather than I'm going to take and then convince myself whether I need to delay, you can put yourself in a better position financially to take care of yourself in your later years if you start on the basis that you can and you will delay, and then find reasons not to, logical reasons not to, if you're going to start those things a little bit earlier. I'm going to stop there because Paul and I were chatting earlier and just want to see whether Paul had anything that he wanted to bring in here. So Paul, I'll bring you back in, let you take it for whatever time you want.
No, I appreciate that, Doug. Yeah, I'll just start with one comment here on your marshmallow test. I mean, the ability to regulate emotions. And at the beginning of the call, I talked about investor behavior and financial planning being the value that our advisors, our coaches are actually bringing to the table. And it really does tie in well to these kinds of things, that the investor behavior is generally, the financial planning approach is generally speaking a successful way to build wealth over time. In terms of a question, yeah, there was one about the aligned to whether I should take it earlier or later. I think some things along the lines of life expectancy and other planning are great, but there was a question about inflation. Is there a break-even point taking CPP at 60 versus 70 with, say, 3% average inflation? Remember those days with 3% average inflation, Doug? I'm just kidding. At longer term, that's probably a reasonable estimate, of course, but we're seeing some larger than average inflation recently.
Yeah, that's the kind of thinking that you should have going into it is if I take early, how long will I be able to do that and take at that early point, get those payments and have as much as would be the case if I started later with larger payments. In terms of the inflation, I know that we're going through this bizarre situation right now where we've had very little inflation for quite a long time, and now we're looking at some of the worst in decades on a current basis, and we don't know how long this is going to continue on. But the CPP and the OAS both are indexed for inflation, and so that part of it, it probably should be neutralized in that calculation. It really does come back much more so to you and your expectation of your life expectancy, or the expectation of your life expectancy, and what other assets you have, other wealth assets that you're going to draw down on to make that decision. Inflation is going to be worked into it, but it's not going to be the main factor, because OAS and CPP are both indexed to inflation. They do go up as the years go by.
Okay, thank you. And there's a secondary question probably applies to spouses primarily. If I delay my CPP until age 70, but unfortunately pass away before I'm applying for it, can my spouse apply to get their portion? Is there a carryover to the surviving spouse if I'm delaying my CPP but don't realize it personally?
Yeah, so if you don't start your CPP, then there is no direct survivor pension over to the surviving spouse in that situation. And though that in hindsight, after the person has died, might look like there's been a loss to the couple by having done that, you have to be careful about making decisions based on the worst possible outcome as the only determinant. It certainly should be part of your thinking. But if there is no known medical condition or family history that would lead you to expect that there is going to be an early death, then the analysis should be based on statistically what you expect to happen, and then emotionally you make a decision whether you want to bring back in those concerns that you might have about the potential that you might have an early death that is out of the ordinary, and decide whether you want to start at an earlier stage. So no, if you die without ever starting CPP, your spouse will not be able to get the survivor component of the CPP in that case.
Okay. Yeah, thank you. There's been a few questions about, is this webinar being recorded? Yes, absolutely, it's being recorded and will be available on our libro.ca events webpage, and we'll provide that link in a follow-up email to all of the registered attendees. And there's another question here about, is this an all or nothing option? You can assume this is an all or nothing option. You either take the full amount of CPP and or OAS from age 65. You cannot choose to take half of the CPP at age 65 to gain more of the CPP at age 70, correct? But can you take CPP, for example, without taking and then defer taking OAS?
Well, the CPP decision and the OAS decision are independent of one another. But on the potential that you could take some of one of the programs, so the example you were giving of some CPP early and then some CPP late, no, you can't do that. That's not possible. And I should clarify the comment that I made about the survivorship. There is a potential survivor pension available when a CPP contributor dies before starting, but the transfer between two spouses, when you both have CPP pensions and then there's the transfer over to the survivor, it's that part of it. And you can see, just trying to explain this in words without us all looking at some big long spreadsheets or tables is really challenging. And that's why having the conversation, as much as we can lay out the big pieces of this, having the conversation with your coach is going to be critically important in understanding first, and then making the appropriate informed decisions once you get to the appropriate time.
And one last question, I'll let you move on, Doug. And if there's any more questions on this topic, we'll certainly circle back to them at the end of the presentation. A common one that a lot of our coaches receive and has appeared in the chat here, and thank you. At what age is the amount at 70 sort of catch up to what you may have gotten if you started at 65? So sort of what's that break even point, I guess, of starting early versus deferring? I mean, if you start late, kind of how long do you have to live to break even to if you started earlier? Does that make sense of what I'm asking?
Yeah, you have to make an assumption about the rate of return you're going to make off of the money that you're going to receive at the early stage to see when the two will catch up with one another. Because if you just do it on a nominal basis and don't have any investment going on, then yeah, you could calculate a date that is somewhere out in the age 70 to early 80s, late 70 to early 80s age frame. But again, coming back to my comment about life expectancy when you are 60, 65 years old, depending on whether you are male or female, life expectancy is at least at the same point at which that so-called crossover would be. And so I would make sure that you really do look at it in a dispassionate way, to consider yourself as a statistic first, as mean as that sounds, and then come back to the emotional aspect of what if I die early, because that crossover point can be very misleading. There's a wonderful study that was done, and I don't think I have it referred in directly in the material that we have here, but it's part of the material that I'd gone through when I put this together long ago. There's a wonderful study with the National Institute on Aging, a researcher by the name of Bonnie McDonald, that looked at the Canada Pension Plan specifically, and the age 70 delay. And it's a detailed rundown on all the considerations. It's quite fascinating to look at. So if you look that up, then you can have a 60-page read through how it is one might go about making that decision about taking or delaying at 65 over to 70 for the Canada Pension Plan specifically. Okay, so here I'm going to push forward here. So I just spoke on the public pensions. Now I want to touch on employer pensions. I don't want to go extremely deep into that. I just want to distinguish these different types of things and then pull things together a little bit more as I progress through this. So employer pensions, where an employer is the one that contributes into the plan for you, or is primarily the one that contributes into the plan for you, those would be registered pension plans, and that could either be a defined contribution, or what's called sometimes called a money purchase plan version of a registered pension plan, where the amount of money going into the plan, the obligation upon the employer, is the known amount. Or you also can have defined benefit registered pension plans, where the known or the calculable amount is how much you will receive out of the plan. And when I say calculable, there's a formula that says if you work a certain number of years and your income is at a certain level, then your pension at age X will be this amount. And that calculation, which is done by an actuary, will then inform back the obligation of how much the employer must put into that plan or top it up if it comes short in the coming years, to make sure there's enough to actually pay you the amount from the registered pension plan if it is a defined benefit type plan. And then we also have hybrid versions of these plans, where some component is defined contribution, some is defined benefit. There are also group RSPs, and it's not as if you haven't heard the word RSP before, but group RSPs are another way that an employer might contribute into a savings plan of an employee. And there's also deferred profit sharing plans. All of these share the contribution room that can go into tax sheltered savings for a given person's retirement. These ones, though, this grouping that I'm showing on the screen here, these are the ones that are an employer's contribution that will grow up the values that would be to the benefit of the particular person as the employee. And then we also have, to turn the corner on this RSP comment that I just made, we also have the possibility of contributing into our own retirement savings, our own decision about whether to do that, with the amount that we can contribute into those plans determined by the working life that we have had. And what I mean by that is your ability to contribute into an RSP is based on your earned income. It's your previous year's earned income that gives you a certain amount of contribution room that you can put into the RSP in the current year. So there's a maximum amount that you can put into an RSP. And then by the time you get out to age 71, you can't contribute any more money into an RSP after December 31st, that year that you turn 71. And in fact, you either have to cash out the RSP or annuitize it to pay you an annual amount, which usually is paid on a monthly basis, but paid out over the course of your lifetime. Or you will take it from being an RSP over into a registered retirement income fund, or a RIF, which similarly you make investment decisions about. And the comparison between an RSP, which has a maximum amount that can go into it, and the RIF is that the RIF has a minimum amount that must come out of it every year once you turn it from being an RSP over into a RIF. So that's the coordination of those two plans, RSP and RIF, the accumulating side being the RSP, the decumulating side, the most common decumulating option being to move over into a RIF. Though, as I said, you could just cash out the money and be taxed on it all in 1 year, usually not a great idea unless it's a very small amount. Or you could purchase a registered annuity, an insurance company issuing the annuity. You give them a lump sum, they commit to pay you a certain amount every single year. And sometimes that would be a good side-by-side way to draw down off of your RIF. Continue on some of it in RIF, but also have a baseline that would be a registered annuity. Depends on where interest rates are, how favorable it might be to make use of the registered annuity as part of your decumulation. Now, once you've got that decumulation happening, one of the things that you can do, you've been able to do it for well over a decade now, is to engage in pension income splitting between spouses, where when you have certain types of retirement income, tax sheltered retirement income, this would be your registered pension plan money, as well as registered annuities and RIF money that you would have. Those amounts, when you receive them as the pensioner, may be split up to 50% of those over to your spouse. You continue to be the owner of the plan that's involved, and you get the payments over the course of the year. But then when you file your taxes the following April or sooner, depending on when you get around to it, when you file your taxes, the two of you can make a joint election that up to 50% of the amount received by the pensioner, the legal recipient, can be split over and taxed to the spouse. If you are under the age of 65, then generally only registered pension plan payments qualify for this splitting. One of the exceptions to that is if you are receiving RIF payments because you have had a predeceased spouse, and then now you got into a new relationship, those payments to you from the predeceased spouse on the RIF will qualify for splitting if you are under the age of 65. But otherwise, if that is not your situation, you don't have a predeceased spouse, then RIF payments will not qualify until after age 65. And similarly, registered annuity payments will not qualify until after age 65. Though again, similarly to the RIF, if you have a predeceased spouse, then you may be able to do that under age 65. Generally, though, RIF income and registered annuities, you have to be age 65 before you can do the splitting. And the extra benefit of doing the splitting is that not only do you split and therefore you're going to reduce down, well, you're going to do it on the basis of reducing taxes. We've got a progressive income tax system where you go up to higher brackets as you go up to higher income levels. And so if one person was receiving all the income, then you would go up through bracket 1, 2, 3, etc., and higher rates that applied on the higher levels of income. If you can split over to the other, you'd rather have two of you at this level than something like this, where you have one of you at a higher income level paying higher taxes on that higher level of income. The extra, though, is that the amounts that are split over to the receiving spouse, if I can call that person by that name, are qualified for the pension income credit as well. So the first $2,000, the federal amount is $2,000. It varies a bit how much qualifies under the provincial tax rates. But the first $2,000 federally gives you a 15% tax credit on that first $2,000. So it reduces down your taxes to the person receiving it by federally 15% of $2,000. So it's worth $300 federally. Provincially, it varies. In Ontario, it's the lowest bracket rate is 5%. So you get another 5% of that. So another $100 tax reduction. So $400 total that you could reduce the household family bill by having that much of $2,000 split over to a spouse who otherwise didn't have any kind of pension income. So that's another benefit that we have of doing pension income splitting. We also have the possibility of having personal savings that we make use of, which are not related to employment in any way. So the tax sheltered program we have had since 2009 is tax-free savings account. The nice thing about tax-free savings account, you don't get the benefit of a tax break on putting money into the TFSA. There's no deduction associated with it, but you get the tax sheltering within it, and then withdrawals from it are not taxable either. So it's a really nice program that can be used and can be reused over the course of your lifetime, because you pull money out of a TFSA for every dollar you take out in a given year. You get credited more contribution room the following year, as well as each of us over the age of 18 as Canadian residents getting a certain amount of TFSA room just because we are over the age of 18. We get $6,000 of room each year anyway. And then again, if you're drawing money out of the TFSA, whatever you take out this year, dollar for dollar, you will get an additional amount of room next year on top of your $6,000 of room that you would otherwise be getting. And then we also have the possibility of just making use of investment savings in non-registered accounts, meaning that they don't have special tax sheltering associated with them. They're not given the extra benefits of an RSP or a TFSA with those tax sheltering characteristics, but you are putting money into those, and when you put the money into those, the amounts that you put into them are your contributions, your cost base on those. It will have income that is generated off of that income, and when you draw off of that, You will perhaps realize some of the growth in value as capital gains, and that will be taxable, although only half of capital gain is taxable. And then the amounts that you are taking out, which is your contributed money that can be tied to the contribution in, those are not taxable. So it's a little bit more complicated how non-registered investments operate, but they open up the possibility of coordinating this drawdown, the non-registered, with your TFSAs, with your RRSP RIF savings, as well as the public pensions and the decisions you make about when to start those things. So you start to see, you add these different ways that you're going to accumulate these sources of money, and it opens up possibilities, complications perhaps, but possibilities of how you're going to draw down off these various things to try to put you in the best position to be sustainable, so you have what you need to live the life that you want and not run out of money. If you have a business, you have the extra possibility of winding up the corporation. Maybe you keep it going and just have dividends continuing being paid to you, or you sell it off and realize one big splash of money at one point in time, or maybe you sell it off in chunks over time and you realize parts of it in different years, which again, because we have this progressive or graduated tax bracket system, that might then keep your tax bracket lower rather than having a big lump sum of money that pushes you way up into high bracket. If you receive parts of it on a year-to-year basis, maybe you push yourself into a mid to high level, but not way up into the top bracket as you take that out over the course of a number of years, if you can arrange the sale of your business in that way. And then one last thing to touch on here is the use of life insurance. Life insurance is designed as its primary purpose to be an income replacement if you, as the person whose life is insured on it, are not able to contribute to your household any longer because you died. Then this lump of money will then be a proxy for you as a contributor into the household. But life insurance has extra benefit to you under the tax system, where if you make extra payments into certain types of life insurance plans, you can prepay the premiums, which will be due in later years, and the prepayments are entitled to tax sheltered growth within the life insurance contract. So that might be something that would be an additional option of how you save your money towards not necessarily your own later years, but perhaps to allow for an efficient transfer of money from you to your surviving spouse. If you're the older one, particularly if you're the male, we go first more often than not. Or if you want to use that as a way to fund the broader family or provide some amount to an estate, life insurance can be a nice way to put that in place. So before I turn to the coordination of all these things, I want to touch on one other thing that tends to come up on conversations about going into retirement and decumulating is your home, where you're living, and the notion that you might downsize. And I'm not saying that you don't, but the idea of downsizing is quite often used as a basis for a supplement, a complement to direct savings for retirement. So you can live however you want. You can choose to own a property. You can choose to rent a property. If you own a property, then you've invested your money in a very specific type of savings. You've put your capital into the savings for your future shelter needs. And then if you have done that, the growth in value off of that, fortunately for us, is protected under the principal residence exemption. So that growth in value is not taxable if the property that we own and then we sell is used as a principal residence. I'm not going to get into all the different workings of the principal residence exemption, but it is a very useful part of the tax system that we all can benefit from. What then comes up is what happens when you go into your later years and you're going to downsize. And you have a little bit of a dilemma at that point, a positive dilemma for most people, of what is your downsizing going to look like? Because quite often people will look at their house and say, oh, well, I'm just going to downsize the house. I'm going to go from here that I raised the family in, and I'm going to go into a smaller place, and I'm going to pull out all that extra money that's built up in there, which is a great idea, but practically it may not work out that way. It depends on where you're going to go to from where you're downsizing from. So are you going to move into a different geographic market and therefore a different economic market from where you are living right now? Because if you're just going to move down the street from the 5-bedroom place to the 4-bedroom place, then the transactional costs involved with the land transfer tax, with the real estate commissions and the other closing costs are going to eat up a fair chunk of the money going from one to the other. 10%, give or take, is not an unreasonable number to be looking at. So if you're going to move from the 5-bedroom to the 4-bedroom, or even the 5 to the 3, which is reasonably close, that 10% difference could be more or less a lateral move. Now you're into another place where if you're going to step down from time to time, you're going to have, again, that same issue that you're going to face. So if you're going to go step by step by step from where you are to where you expect to be in your later years, you may in fact not be gaining by harvesting out the value that you are taking out of your house. So it certainly is something which can allow for you to have a dedicated fund of money, whether you intended it or not, that will take care of your shelter needs in your later years. Just be careful that you understand how much you are going to net realize when you go through these steps, depending on whether you're going to go from one step of where you are right now as owning, then into a retirement place where you are paying outright rent and you don't own anymore, or if you're going to move from one place you own to a smaller place and have the transactional costs along the way. So the thing that I wanted to then pull these things together with is to deal with this question that comes up. Quite often people will say, which one should I draw down first? And usually it's a comparison of, should I draw down my registered savings, my RSP RIF money first, or should I do my tax-free savings account, or should I do my non-registered? And I will throw in with that, should I start doing those things, or should I start my public pensions early or delay them till later? So all of these things have a timing component of them. And so I come back to this idea of chess. And whether you are a chess player or not, I'll just give you the quick outline on it. There are 64 squares on a chessboard. Each player has a dozen pieces on the board, or actually 16 pieces on the board. So once you have the 16 pieces of each player on the board, half of the board is taken up by the starting position of all the pieces. White goes first, and at that first move, there are 20 possible moves that white has. And then black goes second, and there are 20 possible moves. By the time white goes as the second move, there are 400 possible permutations to the board of a chessboard. And then by the time each of them have gone 2 times and it comes to the third round, we're up to almost 200,000. And at the next turn, it's almost 120 million permutations that you could see with a chessboard. And so when I say that, what I'm trying to get at is to have an idea that you're going to start one type of your retirement savings, you're going to draw from it and exhaust it altogether, and then turn to the next one and exhaust it altogether, and then move along the line, is really not the way that chess operates, because you're going to adapt in the chessboard depending on what you see at each round. And likewise in retirement, you're going to adapt. With chess, you've got these 64 squares. In your life, you don't have a set number of squares. Your life could go in any direction. There could be changes in things around you that you couldn't even predict, things that are in your control perhaps, but other things that are outside of your control, even if it's your own family. And then there are things that are even broader than that, where the law changes in some way that really has some significant effect on you. So the idea as you go into retirement is not to say what is the best way that I can draw off of these things and then never return to it. You will make a decision about how you're going to draw off of these things as you go into your first year of retirement, with intention of how you're going to draw those down each subsequent year, at least a few years out in time. But then depending on what happens over the course of that year, when you come back around to it, then you will decide how much of each of these things you will draw down the second time around, depending on what's happened with the investments and the available wealth you have and the changes that have happened in the world. I'm sure that everybody 4 years ago, before the pandemic happened, and now last year over to this year, in terms of your expectations of what's going to happen with inflation, everyone is probably looking at things in a very different way today than was the case a year ago or 3 or 4 years ago. So you always want to adapt to the situation that you have, the wealth that you have, and make your decisions based on today, knowing that you're going to adjust things out there into the future. And then just a couple more things before I wrap it up. Here are the 4 groups of savings that I have. And I've then projected this out using ages over the course of your potential retirement years. Maybe you can retire earlier. I have a friend who retired at age 41 because he sold his business and golfed for about 6 months and said, I'm bored, and went back and worked for the guy that he sold to. But generally, you're going to be looking into your 50s or 60s that you're going to be retiring. This grid is to give you a thought process of which of these savings do I have in the first place, and which of them do I expect that I'm going to be drawing from, starting and perhaps even ending over this range of time from 60 to 71. I've kept it down to this range, but it could be obviously broader than that. This is not a numerical to say, well, put $7,000 in this one and $15,000 in another. What it is to put the X's in there just to get a high-level picture of where the money is going to come from which of these places, and then you're going to have that deeper conversation with your coach about what the amounts are that you expect to be available off of each of these plans at those ages that will then inform the decisions that you make about how you will actually draw down off of them. And then the last thing that I want to touch on, again, is more of a conceptual exercise. This is not about the numbers. This thing, I call it decumulation. It is the things that you do in your retirement. So like I said, I mean, my friend who retired and then went back to work, a lot of times people will go into retirement with an expectation that it's going to be leisure time, and we'll spend a fair amount in that leisure time, but then there still is plenty more years, decades of time that you're going to spend your life. So you're not going to sit and rock. You're going to rock on your chair on your patio, and you're going to put a hole in it by the time you go 20, 30 years out in time. What is it that you're doing now that is the way that you spend your days, desirably or because you have to? And that's going to give you a sense of what it is you're going to do in those retirement years. So if every day you have a small coffee and occasionally you have a large coffee, then in your retirement years, maybe you're going to have a mocha latte from time to time. Today, in terms of the things that you do that you like to do, that's a pretty good predictor of the things that you are likely going to do on a regular basis in those later years, in those retirement years. And so rather than looking at retirement as straight up a dollar figure determinant of do I have enough so that I can pay for that retirement that I don't even have a concept of what it is, maybe this kind of a thought exercise, a little bit broader than just this grid that I've got here, of what do I do, what do I want to do, what do I enjoy doing, and then from there saying, well, if I want to do that, if I actually want to do that Southern cruise over there in the bottom right-hand corner, then what's it going to cost me to do that? Do I have my finances at the point where that's actually going to happen once or twice in my later years? And if not, then what adjustments might I make? Maybe I adjust whether I'm going to do a Southern cruise and it's more local cruise, or maybe I decide that I'm going to save in a different way, that I'm going to reallocate in a different way. Just what adjustments am I going to make with my expectations? And that then is going to help me out in understanding the way that I'm going to decumulate what I have accumulated with my retirement savings. So Paul, I'm going to let you come back in. I know that you did at the one point, but I'm going to let you come back in and see if there are any questions that came up while I wasn't yapping away. Or was
No, I
yapping away.
appreciate that, Doug, and some great advice as always, and I genuinely appreciate that there's more to this conversation than just the dollars and cents. As important as that part of the conversation is, what are you going to do? Like, how are you going to spend your time? Am I going to be okay? Depends an awful lot on, well, what do you want to do? And so I think there's a great balance in that conversation. Couple technical questions around income splitting. There was one, do both spouses have to be over 65, or the pensioner only split with the younger spouse?
The person who is the pensioner, the recipient, has to be over age 65, and then you can do the splitting at that point. Yeah.
Okay. And then there's a question here, isn't the pension tax credit only available to one spouse, the contributing spouse?
No, the pension credit is available on the split over to the other spouse when the splitting occurs.
And if both spouses have a pension, I guess that's great conversation to have with your advisor. No, that's what we had in terms of questions. Oh, there's a new one that's just popped up. Do you have a preferred online calculator for income/spending for retirement?
I don't. Paul's heard me say this before. We did the budgeting thing a little while back, and I'm stuck on this. I have 43 different accounts that I put my money into, and I have this ridiculous spreadsheet that actually, it really was built back in the 1990s and has morphed over the course of time. So I don't use an online calculator myself. I direct you back to Paul or your own coach about what things that they have available to them, because they have more dedicated software that might be better than just an online.
Yeah, that's a great point. We do have about 20 online calculators available on the Libro.ca website under the tools. There's a number of different calculators there for some on the impact of fees, inflation, TFSA versus RSP, for example. There's a whole number of different calculators on there, including some around budgeting and some more retirement income projections. If you find that your particular situation is too complex for those calculators, that's a great indication, perhaps, that it might be time to engage a financial planning professional, of which we definitely have some in our coaching ranks.
I will say, though, that the government's own program, the financial FCAC, I can't remember what that acronym stands for now, but the FCAC, which is a department of the federal government, they have a really good budget planner that's available there. And obviously there's nothing commercial about it. I know some people are a little bit skeptical about government sometimes, but there's nothing commercially being sold there. And it gives you a really good rundown of all the possibilities that might be there. So if you're looking for something that doesn't have any kind of a commercial connection, then go on to the Canada.ca and look up FCAC budget planner, and that'll bring you up the link that might be very interesting to read through.
Okay, well, thank you, Doug. I genuinely appreciate your insight and commentary as always. On behalf of all of my colleagues at Libro, I've got the slides working here again. We have over 700 employees with lots of coaches that work to build owner prosperity every day. Whether your situation is you're brand new to investing and you don't even really know where to get started, we have a coach who can help. If you have a multi-million-dollar business farm operation with intergenerational transfer considerations, we have a coach who can help. And we have coaches along the spectrum all the way. We'd be delighted to meet with you and talk with you about how we can definitely help and perhaps apply some of the concepts that Doug's been introducing today. We genuinely hope you got some value out of today's call. As noted, the recording will be available after the event on Libro.ca. There will be a follow-up email with some summary materials about today's presentation and a way to get in touch with us. Again, thank you, Doug, and thank you everyone for joining us, and we hope you enjoy the rest of your evening.